Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, the week was rather dismal until Friday, and then a last-minute rally in the last hour of trading really did pull back up the index values again to something a little respectable. But it was certainly a drift downwards all week. It'll remain to be seen whether the late-day rally on Friday will really carry over into Monday. The rally was really fueled by late news that bond insurer Ambac Financial was probably going to receive a bailout package, and this certainly lifted the spirits of the market regarding this whole sector. The general worries regarding the financial sector were really responsible for the market's rather poor performance last week overall, and the steady drift downwards until the Friday night rally. Well, next week there's lots of financial and economic news for the market to digest coming out. All week, nearly every day, there's an important economic report, and this will really determine market direction in the next few weeks. Also important will be the Fed Chairman Ben Bernanke's report to Congress midweek over a two-day meeting. The markets will certainly be listening carefully to his remarks to see if there's been any real change in the rather gloomy economic forecast and prospect that he painted the last time he spoke. Let's take a look at this week's Nasdaq chart. We're going to take a look at the one-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks, where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark. At 2,208 was the worst level before we had the pullback that we've had in the last week or so on the promise of a nice fiscal package with some tax cuts, and of course the Federal Reserve stepping in with an interim interest rate cut, followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak, and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, and one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here, and that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback or consolidation over the next few weeks, before then the market would probably turn southwards again. Well, we would still categorise the market movement over the last few weeks as one of consolidation. In fact, there's been the formation of a rather dramatic triangular consolidation pattern, which is starting to form its point at the moment, and we do feel that with all of the economic news coming out next week, the market will have an opportunity to make a decision as to where it feels the market is going, and the breakout either to the upside or the downside that is normally signalled by the approach of the point of a consolidation pattern is likely to occur. The real question, of course, is which way is the market liable to break out, and We feel that this all really depends on next week's economic news. And unless inflation and economic fears for a recession are not really damped down by the news, we feel that the more likely scenario is that the market will break out to the downside. But the market can be full of surprises, and it wouldn't take much good news to fuel another short rally and break out to the upside, but we do feel that any such breakout would be short-lived, and a large amount of selling would then take place to stop the market in its tracks, and then probably reverse. We do feel that it's going to take a lot of good news and a real feeling that the economic situation that we have at the present time is really changing for the better before the market's going to react in any real positive way and change the downtrend that we've seen over the last 7 to 8 months. But as we said, the market can surprise us, so we're going to be keeping a very close watch on events this week, and of course get back to you next week with a full report on the market action. Until then, it's goodbye from London.